Good morning, everybody. Welcome to this AXA Investment Managers Roundtable. I'm Steve Hayes at Bellier in Amsterdam. I think today we probably have the two most important investment stories in the market today. And we've got a very inspirational set of speakers, I think, for you as well this morning or this afternoon, depending where you are. If you have any questions during the roundtable, please put them in the chat room and I'll try and ask them to the speakers at a suitable moment. We haven't got much time today because the time is quite tight for all the presentations. So if you could do that, that would be great. We've also changed the running order of the speakers, and Richard McGuire will now go on first. So it's not the same running order as you have on your invitation. The first storyline is really on fixed income markets and the rates outlook and the inflation tantrum, or is it an inflation tantrum? Is it something more serious? Our speakers will address that and the outlook for the credit markets as well. The second strand of the roundtable today is the green strand. Next week, next Wednesday, we have the SFDR implementation, the green audit, if you like, for institutional investors in Europe. And that could be the starting gun for a much bigger story as institutional investors integrate ESG into their portfolios, and we have global standards, but we'll find out about that later as well. And then we're also looking at the US fixed income market, the biggest in the world, of course, and what is happening there in ESG compared with Europe, particularly in credits. So without further ado, I'll move on to our first speaker, who is Richard McGuire, Head of Rate Strategy at Rabobank. One thing that probably differentiates Richard is that he, in his role at Rabobank, he differs from his peers in that his strategic ideas are actually backed by live, not paper trades. So actually, he puts his money where his mouth is. So Richard, please, if you could take the screen.
Great. Thank you, Steve. I will just share my screen. Okay, so hopefully that's visible to you. Good afternoon, everybody. Thank you very much for joining. My name is Richard McGuire. As Steve mentioned, I'm Head of Rate Strategy at Rabobank. What I've done today is I've taken a few slides from the presentation that I've been giving to clients recently to give you a flavor of the story that I have been sharing with them. As Steve said, time is quite limited and I have been quite ambitious, so this will be an intense 15 minutes. You will need to fasten your seatbelts, but I will of course try to address any questions as they arise. The first slide, which you can see before you, undoubtedly the best slide in the presentation. If you look at the picture, some of you may see a man running away. Some of you may see a dog coming towards you. This has been a little bit of an internet sensation recently. It's an illusion, of course, but the reason why I put this picture on the front is we think that reflation, or the notion of reflation, is also itself an illusion. Within that overarching theme, what I'll try to do today, and necessarily quite rapidly, so I'll give you a high-level summary of the 12 or so charts that I prepared, I will try to answer the following questions, which is, what is it that's been driving the reflation trade in recent months? We specifically focused on the US here and found that the drivers behind the reflation trade have actually changed, which is important in terms of considering how much further nominal yields could rise. Then we look at a number of arguments which those supporting reflation have put forward, pent-up demand, the savings that have been built up through the pandemic being used to support consumption, fiscal stimulus, budgetary spending, Biden's stimulus plan, base effects in the form of low inflation last year, and food and energy prices. All of these, it is argued, will see inflation rise and long end yields with it. Is that true? We focus then on the Eurozone government bond market, and we'll share with you what we're advising investors to do if they believe in reflation or if they don't. And then finally, we broaden out to look at a longer run structural trading view. So to begin at the beginning, this slide here shows the US 10-year break-even inflation rate. We've broken it down into its constituent parts. The orange line is 10-year tips or real yields. The blue line is 10-year nominal yields. The chart begins in the middle of March last year when 10-year US break-even inflation, so expectations of inflation over the coming 10 years in the US, reached a record low of 0.55%. Break-evens, inflation expectations have been steadily rising since then, but the drivers have not been the same. As you can clearly see on the chart here, from March last year to the end of 2020, it was real yields that was driving the move, not nominal. That's interesting because that argues that what was pushing up inflation expectations was an anticipated increase in cost push price pressure, not demand pull. If it was demand pull, you would have expected higher real growth together with higher inflation to result in higher anticipated nominal GDP growth, and that would have seen nominal yields doing the lifting, which wasn't the case. It was real yields, which to us implies that it was cost push pressure that was informing the rise in inflation expectations, the widening of break-evens last year, not fundamental optimism, but rather something more mechanical. We think the weakness of the US dollar through the course of 2020 explains that move. More recently, as you can see on the right-hand side of this chart, the picture has changed. It's now nominal yields after January the 5th that have been pushing break-evens wider, and that is because after January the 5th and the election to the Senate in Georgia, the two seats that were up for grabs there, the Democrats unexpectedly won both seats, and that saw the market much more optimistic in terms of fiscal stimulus, and now pricing in greater real demand, which in addition to higher inflation pushed up expectations as regards nominal growth. And that's why, in contrast to what we saw last year, it was nominal yields that were doing the lifting in terms of pushing break-evens wider. That's an important distinction, because this argues that the rise in nominal yields that we've seen for much of this year, not all, but much of this year, was in actual fact driven by a brighter fundamental outlook. So the key question, how high can nominal yields rise before risky assets are challenged, the value of equities and corporate credit, etc.? Well, the answer is it depends what is driving nominal yields higher. If it is expectations of higher growth, higher inflation, then that should not challenge risky asset valuations, because higher borrowing costs and a less flattering discount rate will be accompanied by more confidence in terms of growth, revenues, earnings, and profits. More recently, though, the picture has changed, and this is a crucial element to focus on. You can see on this chart, the orange line is 10-year US yields, and the blue line, that's the 10-year break-even inflation rates that we mentioned previously. This chart is only over the past 2 weeks or so, from the 10th of February, because what we saw during the second half of February is a very notable development, where, as you can see on this chart, nominal yields in the US continued to rise. But in contrast to what we saw from January the 5th, it was now being accompanied by lower inflation expectations, or a narrowing of break-even inflation. The headlines across the media were still proclaiming the reflation trade during this period, but clearly it was not reflation, because expectations in terms of inflation pressure were actually diminishing. This is a negative cocktail for risky assets, because this combination of higher nominal yields but lower inflation expectations argues that there is no fundamental offset to support risky assets in the face of higher borrowing costs and a less flattering discount rate. And I think this movement here of higher nominal yields, narrowing break-evens, explains why you saw the wobble in equities on both sides of the Atlantic, the pressure that European corporate credit came under, the widening of Eurozone government bond spreads. This is also problematic for central banks, because by definition, higher nominal yields but lower inflation expectations, argues that the rise in nominal yields is an undesirable or unwarranted tightening of financial conditions, because inflation expectations are actually diminishing as borrowing costs are rising. For the ECB, this is a particular concern because the ECB, the Eurozone, is a passenger, a bystander in the reflation trade. The ECB cannot look to imminent fiscal stimulus as the Fed can in the US, nor the success of the UK vaccine rollout in supporting the move higher in yields. And so, as we saw in Europe, similarly, higher nominal yields but lower inflation expectations in the second half of February. That explains why you have seen in the past 2 weeks all manner of ECB speakers come out and challenge the move higher in Eurozone borrowing costs. But the key point I want to make here is, if nominal yields are going to rise sustainably from here, then our analysis in these two charts makes it clear that that can only happen if we are more optimistic fundamentally. If it is not driven by greater fundamental optimism, but something more technical, then that move higher cannot be sustained, because it will trigger a correction in risky assets, which will limit the movement in yields, if not see them reverse course. So should we be more fundamentally optimistic? Can we be more fundamentally optimistic? We have our doubts. This is on this chart here, the 10-year US break-even inflation rate yet again. It's on a longer run historical view now. It is already at a 7 or 8, close to 8-year high. So already medium-term inflation expectations are the highest they've been for many, many years, and the market is pricing in greater inflation pressure. This we doubt. We doubt, not least because we think the market is very much underestimating the scale of the permanent damage from the virus. We believe that the financial sector is disconnected from reality in the way that it was in 2016, when it completely underestimated the strength of populism and failed to call Brexit or the election of Donald Trump. Now, I think that our industry is failing to understand the damage across broader society because we can comfortably work from home. To put that into perspective, what kind of damage are we talking about? Well, early on in the pandemic, the National Bureau of Economic Research in the US argued that 42% in the US would be lost permanently. What is 42%? Well, if we look at non-farm payrolls and the job losses there last year, 42% is 9.3 million. That's the red diamond on the right-hand side of this chart. The blue line is the Bureau of Labor Statistics series of permanent job losses through the current and last 2 recessions. And as you can see, the 9.3 million is notably higher than the 6.8 million peak in job losses that we saw during the global financial crisis. The point being, there's a lot of damage that is being wrought by the virus, which is not yet visible because of extraordinary government support. But as soon as that support is withdrawn, that damage will become visible. And to us, that is a challenge to the reflation theme. As is the fact that we think, sadly, that the market is over-optimistic in terms of the future course, the future path of the virus. It's trading, it appears, a sanitized view that coronavirus will no longer be with us in the second half of this year. That is sadly unlikely to be the case. This chart here shows projections of where the UK will be, which is a world vaccine leader at the end of this year, if the UK, as it is currently on track to do, vaccinates 75% of all adults with a vaccine that is 85% effective. Then half of the UK population will not be at risk from the virus at the end of the year. But of course, that means that the other half will be. If you look at the Bloomberg vaccine tracker, at the current pace, the world global herd immunity will be reached in 7.4 years. So the virus is going to be with us for some considerable time, sadly, globally. Even in the UK, which is a vaccine leader, it's still going to be an issue in the coming months. And the government has already warned that it may need to reinitiate working from home or social restrictions in winter this year. That's the key point. The virus doesn't disappear. That is a challenge to activity economically activity, even if we are increasingly able to live with the virus for some considerable period of time. And it also challenges a view which the reflationists have used to support their argument, which is there's a lot of savings which people have built up through the pandemic, and they will naturally spend these savings in the second half of this year, boosting consumption and inflation. Well, if the virus is still with us in some form, then clearly there will be some degree of precautionary savings that investors will want to hold on to. Also, as you can see from this chart here, the bar chart here shows the UK household spending survey from August-September last year, where they asked consumers whether they had increased or decreased their savings. The dark blue column is increased savings, the light blue column decreased. As you can clearly see, high income, wealthy members of society are the ones that have increased their savings. That makes sense, and also they have the lowest marginal propensity to consume. So it's not just precautionary savings, it's the fact that much of these savings will not be spent because they're held by higher earners who will more likely put it into financial assets. Moving on quickly, because I know time is running out, we have the idea that base effects will push up inflation. Yes, as you can see from this chart, this is US CPI, the blue line actual CPI, the orange line projected only by incorporating base effects. And as you can see, the base effects are important, but they are temporary. They will reverse course after May this year. Higher commodity prices, again, will push up inflation pressure, but we would argue, as you can see from this chart, this is something that we've seen before. The move higher after this crisis on the right-hand side of the chart is similar to what we saw after the last crisis, but in both cases, much of this move is due to dollar weakness. It is cost push. As with base effects, over the longer run, that will not generate higher inflation. It will weigh on demand and ultimately prove to be disinflationary. One slight final comment on the reflationists' argument. The fiscal stimulus in the US, that is certainly a bold plan, the 1.9 trillion stimulus plan. Some commentators are worried that this will create an undesirable degree of inflation because the output gap will be more than closed by this spending. Well, we would make 2 points here. Number one, the output gap is very hard to measure. We've no idea where it is. And number two, the relationship between the output gap and inflation is clearly not what it used to be. On this chart here, the orange line shows that the output gap in the US, estimated by the Congressional Budget Office in the 2 years prior to the pandemic, was positive. So actual output was running faster than potential, but the blue line, core PCE deflator, the Fed's favorite measure of inflation, actually fell during this period, the very opposite of what the textbooks tell you should happen. We're not doubting that this stimulus will generate higher demand. We are doubting whether it will generate an unnecessary degree of inflation, because the textbook relationship between the output gap and inflation is not what it used to be. But bear in mind, we do have inflation expectations running at their highest level in 8 years. What we are recommending our investors do to protect themselves from an uncertain outlook in terms of US and German yields, where clearly we do not believe in reflation, but the momentum has been hard to fight. We are neutral in terms tactically the outlook for US and Europe and German yields. So we are advising our investors to hedge themselves or insulate themselves from this uncertain outlook by going long the long end of semi-core Belgium or French or peripheral Spanish, Italian or Portuguese bonds versus Germany. Because as you can see on this chart, the orange line is 10-year Italy versus Germany. The blue line is the daily change in Bund yields. We've seen a very volatile Bund market, but through that entire period since May last year, Italy has been narrowing versus Germany, whether Germany is selling off or rallying, because in risk on and risk off, higher beta assets, risky assets outperform, because if we're trading a recovery and reflation, that's fundamentally good for risky assets. If we're not, we expect more ECB support, also positive for risky assets. And my final chart. Near term, it's hard to fight the momentum. The market may continue to overshoot on the reflation front. So near term, it is difficult to anticipate an outperformance of US Treasuries versus Germany. But over the longer run, as you can see from this chart here, 10-year US Treasuries have been in a downward channel since the 1980s. That is structural. We believe the coronavirus only supports these structural factors. The channel remains downward, and ultimately, if that is the case, US yields will trend towards zero or negative territory in line with their developed world peers.
Richard, many thanks indeed for your presentation. Moving swiftly on now, our next speaker is Rients Abma. Rients
yes.
Has been the executive director of Eumedion, and I hope I got that right this time, Rients, since January 2006. And Eumedion is the Dutch corporate governance and sustainability platform for institutional investors. So for the largest institutional market in Europe, in the Eurozone, and the fourth largest in the world. Rients, could you take the screen, please?
Yes, thank you very much, Steve, for this kind introduction. So good afternoon to everyone. My name is Rients Abma. I'm Executive Director of Eumedion, and Eumedion is indeed the corporate governance and sustainability platform for institutional investors that hold shares in Dutch listed companies. We currently have around 55 members, pension funds, asset managers and insurance companies, and not only the familiar Dutch names such as ABP, APG, PGGM, NN Investment Partners, Robeco and Aegon Asset Management are member, but also the largest non-Dutch asset managers such as BlackRock, Capital Group, Schroders, Aberdeen Standard Life, and also AXA Investment Management. Our members represent around 7 trillion assets under management and represent around 25 till 30% of all Dutch listed shares. And our mission is to increase or raise the ESG standards of companies within Europe by protecting the rights of minority shareholders and to increase transparency of listed companies so that our members can make more informed investment and voting decisions. And with such a high amount of assets under management comes also responsibility, of course, and therefore we are also stimulating our members to act as responsible and engaged share owners of companies they invest in, and to inform their beneficiaries and clients and the wider society how they invest in companies and how they voted at shareholders meeting. For that purpose, we also have developed the Dutch Stewardship Code containing principles for acting as a good citizen. So our members, institutional investors, have a primary responsibility towards its ultimate beneficiaries, such as pensioners and employees who pay pension contributions and clients of asset managers. And an institutional investor therefore invests directly or indirectly for the account and risk of the underlying beneficiaries and clients. An institutional investor's objective is therefore to achieve good return on its investments at a responsible risk. But a growing number of institutional investors have added another criterion to this. Companies must meet minimum requirements in the field of environmental and social policy and governance, ESG. And in addition to the already existing legal ban on investing in cluster unit manufacturers, and individual institutional investors often have a more far-reaching exclusion policy, stipulating, for example, that no investments are made in the tobacco industry, manufacturers of controversial weapons, and coal companies. However, it is becoming increasingly mainstream to include not only ESG factors in the exclusion policy, but in the entire investment policy of an institutional investor. And in addition to financial factors, ESG factors are increasingly used in assessing the return on and risk of potential investments. Topics such as working conditions within companies, the level of employee and customer satisfaction, board and workforce diversity, relations with local communities, the environmental impact of companies' activities, and the risks and opportunities presented by climate change for the company's business model are becoming increasingly important for institutional investors with their long-term investment horizon to take into account in both risk management and the choice of companies they are investing in. And as a consequence, institutional investors increasingly prefer to invest in companies that demonstrate beneficial social and environmental impact alongside a solid financial return. And this is not only driven by the investment beliefs of institutional investors and the preferences of their beneficiaries and clients, but is also so-called nudged by legislation. And one such piece of legislation is the European Sustainable Finance Disclosure Regulation. Our members are currently working very, very hard on the implementation of that regulation, and they should be ready on the 10th of March, so next week. This regulation obliges all European institutional investors to be transparent on their policies on the integration of ESG risks in their investment decision-making process. And this applies to the complete investment portfolio of European institutional investors. So not only equities, but also bonds and credits, for example. It is not only applicable to institutional investors with a statutory seat in the European Union, but also applicable to non-European institutional investors that have European asset owners as clients. So it has a wider scope than only European institutional investors. And therefore, many, many big institutional investors are now working very hard to be on to finish off their implementation process on Wednesday next week. The regulation also contains specific requirements for setting green or ESG financial products in the market in order to avoid green or blue washing, so to speak. And institutional investors should also be transparent on whether they consider so-called principal adverse impacts of investment decisions on sustainability factors such as the environment, social issues, and the wider society. So it is an enormous, complex burden for institutional investors to implement it. And the real challenge in the implementation of this regulation is the lack of relevant, reliable, consistent, and therefore comparable sustainability information published by investee companies. We now see the crazy situation where investors are legally required to publish information about the sustainability level of their investment portfolios, while the investee companies are not legally required to publish key sustainability figures and statements. It is for that reason that we very much promote the establishment of a worldwide sustainability standards board that will issue uniform sustainability standards so that all listed companies, preferably worldwide, will be required to publish standardized sustainability information. In the meantime, many institutional investors have to rely on information of ESG rating agencies. And this is not a preferable route as there are many differences in these ratings also because of the lack of consistent and comparable information published by the source, the investee companies. And moreover, sometimes rating agencies miss crucial aspects of ESG analysis. And this also shows that a bottom-up analysis with using information published by investee companies themselves is a better approach to identifying companies with good sustainability characteristics and policies. And therefore, we are very much welcome the decision by the IFRS Foundation, the supervisor on the International Accounting Standards Board, that this foundation should not only play a role in setting financial reporting standards, but should also play a role in setting sustainability reporting standards. And that this foundation is now preparing itself for establishing a worldwide sustainability standards board. We also welcome last week's issued support of the International Organization of Securities Regulators, IOSCO, including the US SEC, for this idea. But not only securities regulators are enthusiastic, but also other stakeholders, such as listed companies, are quite enthusiastic about this idea, as became clear from the 576 comment letters that the IFRS Foundation received on a consultation document that was published last autumn. The foundation now announced that the establishment of this Sustainability Standards Board will take place at the meeting of the next UN Climate Change Conference, the COP26 in Glasgow in November this year. And this would be a very huge step in recognizing that financial information will be even important as source for the investment decisions of investors as financial information is. And this can be used by the institutional investors in making the European Sustainability Finance Disclosure Regulation to be a success. So that's my story. Back to you, Steve. Hopefully there are some questions on this topic.
Please. Thank you very much indeed. This would be, seems to me to be actually huge news, that if the world is now coming together with a new Biden administration and wants to go for global ESG standards on financial reporting, which will presumably create a level playing field for all institutional investors around the world in economies like Japan and also China as well. Could the European Union achieve what it did with privacy standards in actually bringing the world up to another level? And is this just going to be in time with COP26 coming up in November?
Yeah, so there is a complication because the European Union would also like to make the sustainability standards. This opportunity for the European Union should, of course, fit into a worldwide solution for making worldwide standards for on sustainability reporting. So how this would fit into the agenda of the Green Deal of the European Union, that is still to be seen, of course. But we hopefully, together with the United States, under the Biden administration, will also give an impetus to work on a global solution for having worldwide standards with respect to sustainability information, as the European Union did with recognizing the International Accounting Standards Board as the worldwide standard setter for financial reporting standards. And hopefully they will come together at the end of this year.
Okay. We have a question from Marijn Jongsma at Elsevier, although I'm wondering whether it might be for Rebecca, actually. Are there big differences between sectors, regions, and how will this influence the portfolio of big institutional investors in terms of ESG reporting? The idea is that there would be a common standard across the world and regions. And
yes, indeed. So that is the end objective. I think the companies that already publish detailed information on sustainability factors are already attracting more institutional investors because they are very keen in investing in companies that receive a high sustainability score. And you can also see with the popularity of so-called ESG indices that companies that score high on these lists of index providers will also in due time become more and more popular for institutional investors. So it is also to the benefit of the companies themselves to not only start with their own methodology, but at the end, of course, to also publish more comparable information on sustainability. And that is the reason why we very much support the development of worldwide standards on sustainability information so that institutional investors can compare the sustainability scores amongst the investee companies.
Thank you, Rients. We may revisit that question with Rebecca, but we have to move on now. Thank you very much indeed for a fascinating presentation there. Robert, we now have Robert Schumacher, the Chief US Strategist and Client Portfolio Manager for Fixed Income at AXA Investment Managers in the US. Robert, please, the screen is yours.
I'd like to say welcome and good afternoon to all of our guests. I want to build a little bit on what Richard laid out for you. I think it was a very compelling case. We would concur with what Richard was laying out. We would bolster that case in one sense with his reference to break-even analysis. We think there is a compelling case to be made that because of the action of the Federal Reserve in terms of its open market purchases to include Treasury inflation-protected securities, that there is a distortion in the signal that is coming from the break-even analysis when you look at the Treasury inflation-protected securities market. And that distortion is the Federal Reserve has increased the holdings from around 7% of the outstanding securities to now in excess of 23%. So while it may lend itself to a very interesting story that investors are looking forward, I think the slide that he put forward showing that those break-evens were actually starting to roll over is a compelling argument that we think there's a technical issue as well as a fundamental issue why the reflation story doesn't make all that much sense in the longer term. But I do want to point out on the slide that he discussed in relationship to permanent unemployment, because I think that gets at the heart of what we're starting to see from the US Federal Reserve and especially the Powell Fed. I would refer you to the measurement of unemployment that is called U6. U6 is the broadest measure of unemployment in the United States, and it includes those that are working part-time for economic reasons, those that are only marginally attached to the labor force, and those that are unemployed. What that number tells you is that the unemployment rate in the United States is approximately 11.1%, not 6.3%. With that as a backdrop, we go back to August 27th of last year, where Chairman Powell made it very clear that the Federal Reserve would in fact be moving to guide the US economy through its policies towards what they consider to be full employment. Now, they didn't define what full employment was, but we have since learned from that point on in additional speeches, and more recently to the Economic Club of New York, Mr. Powell made reference to the 1946 Employment Act. And the 1946 Employment Act essentially was the US government suggesting or passing into law that the job of the policymakers is to make sure that the unemployment rate in the United States was, well, it was originally written to essentially guarantee every American a job. It didn't make it into the final legislation, but more importantly, it is the 1946 Employment Act is the foundation for the 1977 Humphrey-Hawkins Act, which gave the Federal Reserve that dual mandate, the full employment and stable prices. Now, for Chairman Powell to refer to that in a speech to basically sell-side economists, I think sent a very powerful message. I think what you are seeing is a combination between the US Treasury and the Federal Reserve that you only gain a sense of from what they did back in March of 2020. I kind of like to call the combination of Treasury and the Federal Reserve T-Fed, and take you back to dinosaurs, where you essentially the most feared creature on the face of the earth was Tyrannosaurus Rex. Well, let's have a T-Fed. And I want you to just consider the power that that combination has. That combination in and of itself can do whatever it wants in the financial markets. Now, while it's interesting that they don't seem too concerned about interest rates moving higher, and I think that's correct in terms that it's temporary, it's commodity driven, there is concern overall because they want to make sure that overall interest rates do not slow down any kind of growth in the economy, but more importantly, it does not slow down the creation of jobs. The Federal Reserve will continue to position their policy along with the Treasury. You've heard Janet Yellen, the new Secretary of the Treasury, former Chairman of the Federal Reserve, saying we need to do more. And we're going to see more. And that's where I shift my conversation to give you a sense of what's happening in Washington, D.C. I don't believe even people in the financial industry in the United States fully understand what's happening. I will mention a name to you. You may not know this name. I would encourage you to dig a little deeper. This woman's name is Stephanie Kelton. Stephanie Kelton is an economics professor. She is a very, very strong proponent of modern monetary theory. And we don't have time on the call to go into what modern monetary theory is. She wrote a book called The Deficit Myth. It's a very easy read, but it's a very interesting story. Stephanie Kelton, in her advocacy of modern monetary theory, caught the attention of one Senator Bernie Sanders. She became an advisor to the Sanders campaign. As the Sanders campaign stepped aside ultimately to allow the Biden campaign to move forward and be successful, she became an advisor to the Biden campaign. And her concept of monetary theory, I believe, has been fully embraced by the Biden administration. Now, they're not going to come right out and say it because there's enough skeptics, but the concept of government spending and the concept of government deficits and the concept of, well, we have to live within our means is, I will tell you, being turned on its head in Washington, D.C. The old model was essentially tax and borrow and then spend. The new model is spend, tax, and borrow. And not necessarily you have to do all the tax and borrowing if you have the combination of T-Fed at your back. So while there may be some expressed concerns in the market in relationship to the size of the deficit, the thought process in, I think, the inner workings of the Biden administration is they're not worried about the deficit. They're not worried about it at all because their point of view is the United States is a currency issuer. They're not a currency user. And that changes the dynamic of everything. So if I'm truly driving the unemployment rate lower, the U6 rate from 11% to 7% to get us back to where we were in January of 2020, I'm going to need tools that do that. And those tools, instead of solely relying on monetary policy, are going to rely on fiscal policy. The first aspect, you see it, $1.9 trillion stimulus plan. $350 billion goes to the public. They're not going to spend it all. We know that. We know government multipliers are never one. They're far less than one. But it's what's behind the $1.9 trillion stimulus package that will be even more interesting. It's not inconceivable to see a $2 to $3 trillion infrastructure plan. It's not inconceivable to see other programs coming down the line. So while there's ultimately concern that being expressed in relationship to interest rates and inflation and all of that, the policy side of it is not worried about that. So really, I look at it and go, what are investors supposed to do? Well, for the time being, investment grade investors, they got a little problem in terms of that's a longer duration asset. And the longer duration asset has suffered somewhat in terms of interest rates rising. But some of that's been made up in terms of spread. I take a look at non-investment grade, high yield securities. That's a shorter duration asset. But both of them, the key is that policymakers are not going to withdraw liquidity. All of this talk of moving the interest rate hikes forward from 2024 to 2023 to, oh, they're going to have to taper in 2022. That's not where they're coming from. Where they're coming from is they're going to be moving the U6 unemployment rate towards 7%. So I would close my comments and say to you that we are in concurrence with what the path that Richard has laid out. We think there's some temporary dislocation going on here, but we think that will ultimately subside as what we call the four driving forces of interest rates, that being demographics, technology, globalization, and robotics, will continue to weigh heavily on the direction of interest rates. And we think at the end of the day, that's down. That will in and of itself benefit credit investors. So I will leave my comments there, Steve, and turn it back to you.
Thank you very much indeed, Rob. Very succinct, and you've helped us a lot get back on the path of the time. Rebecca is now over to you. Rebecca Greenberg is an ESG specialist at AXA IM, leading the efforts of AXA in high yield and US fixed income teams to incorporate ESG within their respective investment processes. So she works closely with AXA IM's responsible investment team as well as other investment teams globally, while serving on multiple committees focused on firm-wide ESG strategic issues. Rebecca, the screen is yours now. How do you feel, how advanced are US credit issuers, investors in integrating ESG into their financial reporting relative to the same groups in Europe, do you think?
So I would definitely say, you know, if you would ask me this question 12 to 24 months ago, I would tell you that European issuers were definitely ahead of US issuers. I think that landscape is evolving quite quickly. On the investment grade side, you know, I think almost every single company we cover now has some form of sustainability reporting. You know, again, the earlier comments around the fact that it's not always consistent is, you know, one of the bigger issues, that we have different companies reporting different things. That's a problem we have in Europe as well. But in terms of the sheer amount of reporting, US companies are catching up very quickly. On the high yield side, which was further behind the investment grade side, I would say probably in the last 6 months, you've even seen high yield issuers move towards ESG reporting. You know, my colleagues that focus on high yield have been telling me in the last round of earnings calls, tons of companies are now talking about ESG and now have ESG slides. So I think, you know, just, you know, some reference point, the Sustainability Accounting Standards Board, SASB, recently said about 12 months ago, they had 79 companies in the Americas reporting on their framework. Now it's up to 255. And it's rapidly changing, I would say.
The gap between investment grade and high yield, do you think is narrowing very quickly?
I think it's definitely narrowing. I think, you know, a lot of that will depend on what kind of regulatory, you know, regime we end up seeing, because of course, you know, if issuers are mandated to disclose, they're going to have to disclose. Now this point does come back a little bit to the earlier question on differences between sectors and regions. And one of the things that I would say that may be a difference, this is a two-part, the regional question, there's sort of a two-part thing here. The first is, and IOSCO in their release last week did say that they want to coordinate these two approaches, that we are seeing some regions of the world like Europe move towards this very wide sustainability concept that's focused on disclosures for broader stakeholders like communities and employees and things like that, and not just shareholders or fiduciaries or other investors. In the US, we still see a little bit more talk of this more financially material sustainability factors, or the sustainability factors that that add to enterprise value creation or destruction. So, we will probably see, the amount of disclosure we get in investment grade and high yield companies will, in the US, depend on, what if the SEC decides to move more broadly or to stick with the sort of financially material sustainability idea. The other thing will depend to, in the past, last year, we saw them require companies to disclose anything related to human capital that management deems material. And the SEC does this frequently. They leave it up to management and companies to decide what is important to disclose, rather than, in the EU, where, we almost certainly will say, you must disclose this. If we do see a model in the US where it's up to companies to decide what it is that they believe is material and what they're going to disclose, I think we will probably see more disclosure coming out of investment grade companies and high yield companies, just because they're bigger companies with more going on. So there's probably more issues. That being said, high yield companies are generally smaller and more concentrated. So if an issue is material, it's going to be, more material. The one other thing that I would say too is that, we probably will also continue everywhere, both in the US and in Europe, to see more disclosure out of bigger investment grade companies, because they do attract the attention of NGOs that are focused on sustainability. NGOs are watching them more closely than they are smaller high yield companies. So, to sort of deal with some of the issues that NGOs see in these companies, I think we will see, the bigger companies continue to disclose more. And obviously they have more employees and more resources to do more robust disclosure. The one difference I think we could see within the high yield market is between publicly, companies that are publicly owned versus companies that are privately owned that have publicly traded bonds. We're still very much in the early days of this, but we are starting to see some, activist shareholder investors that are focused on ESG. So, and, between that and the power that shareholders have from voting, I think I think it is likely over time that we will see that private high yield companies maybe do disclose a bit less than even public high yield companies.
We also have a question actually from Ronald Koch at Analist.nl. Ronald's asking, would the costs of green investing go lower? I mean, if everybody's doing it and you get a premium for doing it, do you think the relative costs of investing in ESG for companies will go down?
So, I mean, I'm not 100% sure exactly what part of green investment this question is referring to. If you're talking about
overall, maybe ESG is a...
Yeah, I mean, if you're talking about the green bond market, which I'm not sure if that's what this is referring to or not, but if it is, we definitely are starting to see that green bonds are definitely coming tighter than a non-green bond deal from the same issuer, for sure. I mean, these deals, if you follow them, are 4, 5, 6, 7, 8 times oversubscribed. Everyone wants to play these deals. I think the more and more of these types of deals we get, I think once we hit a point where there's enough supply of green deals to satisfy investor demand, then we might start to see it normalize again. But for now, these deals, we are starting to see, for a long time, there wasn't a big pricing difference between green deals and non-green deals, but they've become so popular, and everyone, every asset manager wants to tell their clients that X% of the portfolio is in green bonds and things like this, that I think the demand is sort of through the roof on these deals, if that's what question was referring to.
Yeah, thank you. I think we have a question here for Rob Schumacher, again from Marijn Jongsma at Elsevier. Rob, does Kelton, the economist, does she see inflation as a restricting factor in MNT policy? So where would the limits be?
That is a very good question, because the limits had been characteristically set by monetary policy. But with entering the new regime, and I'd love to get Richard's thoughts on this, entering the new regime of average inflation targeting, we are now creating a moving target. So in her parlance, I think it is an acceptable level to the monetary authorities, but then defining what that level is will be an interesting and open question without getting into the mechanics of the way she talks about pulling back funding and that sort of thing. But to assetflation itself, there is an argument to be made that since the largest assets carried by US banks are in fact real estate assets, that the policymakers would encourage some level of asset price inflation, not only in the securities markets, but in the real estate markets.
Richard, I'll come to you on the same question in a second, but I know Rients has to go in a second. So I have a question here from Susanna Russ. What do you think the impact will be of pension funds also having to make disclosures under SFDR, despite them being quite different players from asset managers and banks?
Does she mean under the sustainable finance disclosure regulation?
Yeah, Susanna, try to jump in there, please. Susanna, what do you exactly mean?
Yes, Rients, yes, I mean under the SFDR. So so pension funds are, you know, on the one hand, kind of users of disclosures from asset managers, but under the SFDR, they too have to make disclosures. So that's what I'm talking about. Yes.
Yeah. So there are no differences between the requirements for asset managers and asset owners under the SFDR. So I think the pension funds have to rely on the information they receive from their asset managers. So I think the asset managers and also ESG rating agencies will play an important role in the meantime. Between the reporting requirements coming from SFDR from the 10th of March onwards, and the development of an SSP. But yeah, they have to rely on the asset managers for that, I'm afraid.
And just to jump in on that point too, yeah, we also believe that, you know, that some of this convergence for global standards and uniform standards is going to come from pension funds and asset owners and the ultimate end clients, because they're not going to want different SFDR style reporting from each one of the asset managers that they're invested with and the different banks they're invested with. So, you know, we also think, you know, in addition to, you know, some of these top-down regulatory approaches, we do think that asset owners will end up playing an important role in making all of this much more uniform, because it's much more digestible and usable for them as well.
Yeah. Yeah, they will have a very push factor for more harmonization. I agree with that. Yeah.
Richard, do you want to jump in there over on Robert's point? You're on mute, Richard.
Okay, sorry about that. Yes, I would say, well, first off, I would say that I very much liked Rob's story and his delivery. If he is correct that we are in a new regime and that the Democrats are embracing modern monetary theory, then I think that is something of a challenge to our view in terms of our expectation that reflation is already, there's too much in the price, and that bond yields will fall back in the coming months towards the end of this year, although, albeit probably subject to some volatility in the interim. But I think I'd make 2 points there. Number one, if we take a longer run view, then MMT has really effectively been attempted and hasn't been shown to generate long-lasting inflation. The Japanese did it. It was 2 of the 3 arrows of Abenomics. It was loose monetary policy and an aggressive fiscal policy. In fact, in the 1990s, the Japanese were paving riverbeds, and still they've not been able to meet their inflation targets. So over the longer run, I don't think it's a challenge. Near term, though, certainly it is a threat to our low yield view. In terms of how much inflation is acceptable, well, I think that's a key issue. Rob also referred to the demographic underpinnings of the lower for longer yield view. I think this is one reason why there's never been a political pushback to the fact that central banks have failed to meet their inflation targets in the developed world for decades, in fact, in some instances. That's because the older generation who've become increasingly wealthy through central bank activity and purchasing of assets through quantitative easing, for example, they've benefited from asset price inflation. They don't want consumer price inflation because that erodes the value of the financial assets that they have. We live in a top-heavy aging society, a pyramid demographic. For the larger share of the population, higher asset prices, but no significant consumer price inflation is just perfect. It's not so good for the younger generation who are long income. If you're a progressive Democrat, you're probably happy to accept high inflation because that effectively redistributes from the older generation that hold all the cards in terms of assets towards the younger generation. But the fact of the matter is, the older generation are more powerful, they're the stronger political force. Any notable uptick in inflation in the coming 1 to 2 years surely must risk the Democrats' tenure in terms of holding a majority in the House of Representatives and the Senate.
Thank you, Richard. Rebecca, I have another question for you. As well as covering ESG, you also, interestingly enough, cover the oil and gas sector in the US, which is on the sharp end as regards to possible stranded assets in the future. How do you see the ESG picture developing for you, that sector? Bearing in mind what we've heard today on the bigger ESG story gaining momentum as we move towards Glasgow. What's your view there?
So I think in the short term, we don't have material credit risks here. The equity story may be different, for investors focused on growth, equity growth. But I think on the credit side, we don't have a ton of short-term material credit risk. I think over the medium to longer term, this definitely can change and is definitely likely to change, and we definitely will see credit risks in this industry. I do think it does somewhat depend where on the energy value chain a company falls. For example, if we continue to see electrical vehicle sales pick up in a more meaningful way, I would think that the downstream part of the business that's exposed to gasoline refining and gasoline sales is more likely to face credit risks before something like natural gas infrastructure. I think I think COVID has accelerated this a bit, but I think one of the other, factors at play with the energy transition is also some of the S issues or social aspects to the transition. And I think, you do see regulators and companies, especially in the power generation sector, focused on affordability and reliability to their customers. And so I think for that reason, natural gas is so abundant and so cheap in the US that I think it will be, definitely some time before we are fully out of natural gas here. So I would, you've probably heard this term before of people saying, natural gas is a bridge fuel. I think that is definitely true, at least in the US market. So I think the credit impacts to the, natural gas infrastructure part of energy, probably have a longer horizon, longer away than, other parts of the energy value chain. I think, obviously, AXA IM did join the Net Zero Asset Managers Initiative, which aims to be net zero carbon emissions by 2050. So obviously, we think this is certainly coming and the credit risks are coming, but, I think that they're more medium to long term. one, thing that we could see, but this is probably more, this definitely impacts sort of the lower rated high yield companies more than it will the bigger companies, is if we do see the Biden EPA come out with more stringent environmental regulations on things such as methane emissions, things like that, which may make it more costly for smaller producers. The big producers with strong balance sheets, this probably won't have very much of an impact. I mean, it will impact margins, but not in such a meaningful way. At the low end of the rating scale, I think we could see more. But I think at the end of the day, it will also be company specific about which companies make the right investments in the energy transition, which companies make the right bets on the right technologies, which companies right size their balance sheet for a changing industry, and allocate capital accordingly. So I think some of it will be company specific. The US majors are of course behind, in terms of laying out plans from the EU majors on reducing exposure to oil and gas. But even the EU majors, it's still, these companies are still very much dependent on oil and gas. And at the end of the day, they're going to fund their transition for the next, decade or so, at least, through oil and gas cash flows. So, they're not independent from oil and gas either. So I think, I think, we will, it still sort of remains to be seen how the story plays out. But I think, there will be some companies that adopt and transition and others that don't.
We've run over the time for the roundtable, but so I'm going to give you the last word, Rebecca, unless there are any questions coming in the next couple of minutes. Do you think the incoming Biden administration is a game changer for the US and for the world in terms of moving towards carbon neutrality or holding the line at 1.5 degrees? What difference do you think, or what difference do you sense that the new president has made to the ESG debate and the greening of corporate America? Has it speeded everything up?
I think it definitely will speed things up. Obviously, who knows who will be president in 2024, and if we could see, potential setbacks to what we do in the next 4 years. But I think that, he obviously committed on day one to rejoining the Paris Agreement. His acting chairwoman of the SEC, tweeted in support of IOSCO and has, directed the whole SEC staff to work with IOSCO on creating and working with IFRS on creating this sustainability standards board. They've hired a new advisor responsible for ESG and climate issues at the SEC. So I think, I definitely think that their progress will be made. It remains to be seen sort of how quickly progress is made. But I definitely think, this is the direction this administration is headed in.
Thank you very much. And thank you, everybody. There are no more questions from the media, so I will draw this roundtable to a close. Thank you for very interesting presentations, everybody, and have a good rest of the day. Thank you. Bye-bye.